Both Jack Bogle and Warren Buffett think that having international stocks is unnecessary. Are they right? Keep listening to find out. Welcome to the Money Meets Medicine podcast, where we talk all about personal finance topics you wish you had learned in medical school. I'm your host, Justin Harvey, and here is our co-host, who has on more than one occasion considered trading in his smartphone for a dumb phone, Dr. Jimmy Turner.
You know, I bought this thing called a Light Phone, the Light Phone 2. And I don't know if anybody listening has ever even considered trading in their smartphone. They felt like they had a smartphone addiction, or they're standing there. I mean, this isn't me, by the way. This has never happened to me when my child was looking at me in the eyes and I was looking down at a screen and they're like, "Daddy, you pay more attention to your phone than you do to me." If that moment of pain as a parent has never happened to you, maybe you've never considered this, but I have. And I bought a Light Phone 2, which now sits as a brick in my drawer. It's not to say it's not a good device, not to say that there's not a purpose for this thing. It basically takes away all social media. It takes away, 99% of apps. Actually, there's no app store. It does give directions, little flyby directions that kind of challenging to see when you're driving. But I have considered doing this to the extent where I bought one, no longer use it. But yeah, Justin, we were talking about this beforehand. I think that I'm not the only one. I'm not the only one, am I?
I have, so I use a Google Pixel currently, and I have gone through phases where I have changed the color on my screen to grayscale in order to reduce the dopamine response from, all the notifications and social media and everything. And I think it's worth doing, and I'm freshly inspired now that you have your, what stands as a monument to at least one time I really cared about how much I looked at my phone. I should probably revisit this to make sure that my phone isn't dominating my life more than I want it to be.
Yeah, I'm constantly reminded, since I have a soon-to-be 13-year-old that has a phone, and which she's 13, she can call, she can text, and she has Spotify, and it turns off at a certain time. And occasionally she has limits on there. She'll be like, "Hey, Dad, can I have 15 more minutes? I want to do this one thing." And I'm like, "Fine, whatever." But it constantly reminds me that she's a better human than I am, because she doesn't really pitch a fit about it. So before we dive into this show on international stocks, which I think is a really cool topic, this is something that maybe doesn't get a ton of fanfare sometimes, but then I feel like there's seasons where I get asked about this a lot too. And so it has a variety of applications, and interestingly, two of the biggest voices, right, in the passively managed, index fund arena have both said that, they don't think that they need this. And so we're going to dive into that on the show. Before we do, make sure that you go snag your free copy of the Physician Philosopher's Guide to Personal Finance, or get your own occupation disability insurance quote at moneymeetsmedicine.com. Love to help you out there. All of you know my story. So we try to do that by making it a place that you can trust when you go there to go through your own occupation disability process. Justin, I'm going to do this for you this time, because I know at some point you're going to do this. And so I'm going to do it for you because, you're our friendly certified financial planner friend. So given that we're about to discuss investments, international stocks, just want to make it abundantly clear that this is not specific investment advice. None of the vehicles or investments that we discuss on the show are recommended to you. This is general education in nature only. So Justin, now that I got your disclaimer out of the way, because I don't have to have the disclaimer because I don't get paid to give people investment advice, I want to know what you think, right? So I think it was, I can't remember if it was Warren Buffett, or I think it was Warren Buffett that basically said hey, if when I die and my wife takes over my assets, I want her to have 90% equities, 10% bonds, and 100% of them in the U.S. market. Basically, the 90% I think was even more specifically the S&P 500. And so not only does he say hey, you don't need international stocks, but he kind of lives behind it. In his, I think that was in his Berkshire article that he puts out for, the people that invest in Berkshire. So I think that's a pretty interesting take. I mean, there's not a lot of strong stances like that in the investing community. This is the one stake I'm putting in the ground, but they both did that. The guy that created index funds, and then Warren Buffett, the Oracle of Omaha. I think that's really interesting.
Yeah. Well, it's one of the luxuries that comes with when you start with $127.7 billion of net worth. You can do literally anything you want, and it's hard to go broke.
Probably true.
And, Jack Bogle, the founder of Vanguard and the one who democratized index investing, has said famously on record, in the S&P 500, 40% of revenues or profits are sourced from international companies anyway. So a lot of the international returns are built in. which, these guys are mavens in their own right. And so I have an opinion about these things, but I'm, just some guy and they are who they are. So what you're going to get now is my opinion. And it's important to understand first sort of some basic principles about portfolio construction. Like if I'm going to invest, what am I investing in and why? And if you are a quote unquote passive investor, that means you just buy a universe of stocks. Universe is a technical word that means every holding within having certain characteristics. So there's the U.S. large cap universe. That means any company that's publicly traded in the United States with $10 billion of outstanding market cap or more. If you're strictly passive, you would actually hold, I think it's like 60% U.S., 40% international. So it's interesting to me that for Jack Bogle, Mr. Indexing himself, he's not actually passive. He's sort of passive, but with this big active tilt. Saying this is the universe. It's U.S. large cap, which is actually one of only many different asset classes. So when we're talking, how do we invest? It's a philosophical foundational principle of mine, and academics bears this out too, that broad diversification across almost every accessible asset class is worth doing and is the way to improve expected return and decrease risk over time if you hold it through full economic cycles. I surmise that with Mr. Buffett and Mr. Bogle, what they're really doing when they say, whatever I bequeath to the kids or to the wife, here's what I want them to do, is they're acknowledging the behavioral component, which is, I don't want them to try to pick stocks. I don't want them running option strategies. I don't want them to buy a bunch of private equity stuff that's going to be locked up for 10 years. I want them to buy the S&P 500 because that's easy. It's simple. It's straightforward. It's low cost. It's reasonably diversified because of the breadth of revenue sourcing, and then they can go on their merry way. So I think that's probably what if I'm reading between the lines, I think that's what they're saying.
Yeah, no, I actually agree with you. And the reason I agree with you is because, so Warren Buffett himself, right? He doesn't always eat what he's cooking, right? So like, this is someone who, in at least two different regards, right? So he basically says like, hey, the average investor, you should just be invested in low cost diversified index funds. That is the way to go. That is going to make you successful. You shouldn't do anything else. And then he has Berkshire Hathaway, where he very regularly invests in individual companies quite actively. Now, for Warren Buffett, that is different than like a typical active management, in my opinion, because what he often does is buys the majority stake in a company and then owns it. And so he's now able to like dictate like, well, how is this company actually operating? That's very different than like picking active stocks, owning a small percentage, but still he has active management and he's recommending index funds, to other people. When it comes to, Berkshire itself, he has international companies at Berkshire that he's investing in for this, broadly diversified fund. And so there's a couple of examples where, Buffett's really not following the same advice that he would give to other people. But I do think that he shares one thing in common with us, which is like, a lot of those things that he says, I think are general education in nature, but not necessarily what he has done or what he's been successful with. But notwithstanding, like, I really do think, there's kind of some arguments for this, right? This lack of international stock. There's definitely some arguments against, you've mentioned a couple of things that you're going to get exposure anyway. The U.S. stocks, from like, I think 2009 to 2021, outperformed international stocks. And so people are like, well, it's done pretty well the last, 12 or 14 years. And then forgetting like that massive, disclaimer that comes on every investment ever that says, past performances are not predictors of, future success. That said, it for me comes down to diversification, right? So it comes down to that argument that you made. And I think the most famous example of this that I'm aware of, at least at like a broad scale, is the Nikkei index in Japan that I think I'm pronouncing that correctly.
Mm-hmm.
That in 1990, right, collapsed. Like it went to half of its value. And if like you invested in like 1990 to like, at least the last time I checked, 30 years later, you were breaking even. And so you have this one very large, broadly diversified fund in a very successful modern country in Japan that everybody and their brother, if you weren't investing in the 70s and 80s in the Nikkei index, like you were a loser. And then because if you didn't broadly diversify, your portfolio would have done quite poorly, right? And so like, I do think that there's this argument that, well, if the U.S. economy collapses, like everything else collapses because everyone's dependent upon us. But at the same time, like I think there's a lesson to be learned from that Japanese experience. speaking toward that lack of diversification.
Yeah, this is a deep topic, and the reality is, the like cheap, ready access to national or global stock markets is kind of a new thing. And we like to think that we've got all this data and all this history and all this academic, statistical, whatever, which is all kind of true, but we have kind of a small sample size. If you think about the human history, think about the booms and busts of the bygone years and millennia and centuries, and where we're at right now in 2024, and, the United States and where it is geopolitically, and how, the balance of power, even in the last 5 years or so, has been shifting. Is the U.S. going to continue to be the preeminent superpower for as long as I am alive as a 30-something-year-old? I mean, I'd like to think so, but I have no idea. And so I think that coming with a certain level of intellectual humility goes part and parcel with this idea of we have this funny saying in finance: diversification means always having to say you're sorry, because no matter what, you definitely hold the worst performing asset class at any given time. But it also means you hold the best. And I don't know, if I'm going to live to see the end of U.S. capitalism. The fact is, the policies, the laws, the enforcement, the protection of intellectual property, the way that we have training for our populace, on the whole, has created this incubator for a really powerful economic engine that is up to this juncture relatively unmatched. And yet there are higher growth opportunities overseas for companies that are earlier on in their life cycle of development and, enforcement of law, training of their citizenry, and all those things. And if you want, emerging markets is a good example. It's kind of an extreme example,
right.
But countries where they could double their economic output tomorrow if they had better enforcement of rules or some of the other, protections that would make investment happen in those jurisdictions. When you invest internationally, you get a chance to participate in that. Now, emerging markets has lagged for a long time. And I want to introduce this other principle, which is mean reversion. So as a finance guy, I love statistics, and I think that understanding the principle of mean reversion, which I call the law of financial gravity, which means what exceeds the long-term average over time will eventually return to the long-term average, and what performs below the long-term average over time will eventually return to the long-term average. And if if the average is 5 and I get a bunch of 10, 10, 10, 10, in order to hit the long-term average, eventually you need some 0, 0, 0, 0 to hit that long-term average of 5. So the U.S. stock market it's been awesome, the last decade. U.S. investors, Warren Buffett and Jack Bogle would have looked like geniuses to all the people who took their advice in 2009 and have just ridden this thing all the way up. To those people, I might suggest, and this is not personalized investment advice, but the stage has been set. The difference between the U.S. and international is so pronounced right now because of the length of this outperformance that maybe it is time for the pendulum to swing back. I don't know if it is, but statistically speaking, maybe that's going to happen. And so we'll throw in the show notes this great chart that it shows. If you look back to 1971, there's a 2.5-year time period where there was an 80% outperformance for international markets. And then starting in 73, there was another 3 years where it was 28% US. And then a couple of years where it was 90% outperformance international. It's just like this boxing match, back and forth and back and forth. It just so happens that where we are right now is at, I don't want to say the tail end, because this could continue for longer than we think. But starting in 2008, this almost 300% US outperformance when compared to international markets. But it's like purple, gray for all these time frames that I'm looking at this chart. And if I was believing that mean reversion is a thing, this just shows that maybe it's time to start considering international.
Yeah. And for those of you on the YouTube channel, I'll pop this chart up too, so you can take a look at what Justin's talking about. But I completely agree. And people talk about the Nike swoosh of 2008, 2009 to now, and at some point, I agree. There's that reversion to the mean, and I hate statistics, by the way, hate it. But I do, however, like concepts, And I think it's true, right? I think it's a good concept. And I've even experienced, that kind of concept. And I think a lot of doctors have in terms of like job markets, right? We've seen them swing one way, right? When I was coming out of training, right? I actually at this point don't think I would match into my own specialty because anesthesia has become so competitive and scores are so high. Like I'm pretty certain that I would not have been able to do what I do now. But on the other hand, like when I finished training, like looking for jobs, like there were no signing bonuses. There were no like student loan aids if you went and like, got a job. And like now, like I'm getting emails about these like $60,000 signing bonuses. And we're going to give you another, 40 grand towards student loans and moving expenses. And, and so like the job market swings, everything reverts back to the mean, not everything, but a lot of things financial do. And so, I love this chart because it really does illustrate that point.
Yeah, and one other chart that I really love, and if you can tell a story and show a picture to go with it, that's always the best way to do things. And I just realized I can share my screen here, so I'm going to do that and tell me if this works. This thing they call the periodic table of investment returns. And what this is showing is a bunch of different asset classes. There's, 9 different asset classes represented. Cash, global bonds, global stocks, emerging market stocks, and then U.S. large cap, U.S. small cap, and some others. And what we see here for our listeners who are just going audio only is it looks like just a smattering of all these colors all over the place. And what this shows is it's very, very difficult in any given year to pick which asset class is on the top because there are these trends. Jimmy, if you look from the top left here, emerging market equity is in the top. It's like the top performing, coupled with real estate for 5 years in a row. And the U.S. market is much more towards the middle. And then there's these other secular trends, we might call them, these times where there's in favor and out of favor market cycles for geographies, for jurisdictions, for continents. And there's a lot of reasons for that are hard to understand and even retrospectively are difficult to explain. And what I am making a case for here is because you can't know, Warren Buffett, maybe he can know. Jack Bogle says that he can't know. And by the way, those guys are very different in terms of their approach. Like Jack Bogle is the index because we can't know guy. And Warren he made his money as a professional investor, buying and fixing companies and then putting that capital to work intelligently. But both of them conclude that you can't figure out which one of these little boxes, which one of these little asset classes is going to be on the top of the pile any given year. So just buy all of them and rebalance periodically to your target weight. And that is a path forward that will ensure that over time you're selling high and you're buying low, which is what you want to do. You don't want to sell when it's low. You want to sell when it's high. And when you rebalance, that's what you're doing.
Yeah, no, I love it. And actually, I'm going to get on my soapbox here for a second because one of the things that's happened in the physician finance community in the last, 5 to 7 years that goes pretty much completely against what you just talked about is like this push to buy real estate at all costs and that it should be the only asset that you have and that you should liquidate your 401k or your 403b in order to invest in real estate because the wealthiest people in the world all have real estate, yada, 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 blah, 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 and then invested in syndications recently that folded, right? Because, we have people telling you should do these things. And so, invest in real estate. Have no problem with that. I think it's a great class, and you should diversify in that if you want to, whether that's, real estate flavored stocks through REITs, which is what I do, or syndications or active real estate as a landlord. I honestly don't care. But taking 100% of your money and putting it into an asset class, not knowing which of those asset classes are going to do well or not, I think is really, really, really a huge disservice to people. And to be honest with you, it disappoints me that people get that advice in this space because it, to a lot of extents, is very self-serving. And so, if people are telling you to buy things, you need to follow the dollars, just like any other show we talk about, the conflicts of interest that exist. And at the end of that dollar chain, you're going to find out that those people are profiting from it and you might not. So, just be careful there, and diversification's key always.
Totally. And one thing that I mentioned last episode that I'm going to bring back around is liquidity is really key. So if you're buying something that you can't turn into cash tomorrow, you should have a darn good reason why you're locking your money up. And you need to know what are the terms of the lockup. This is one of the reasons that I come in skeptical in terms of syndications because they're not all created equal, or even, buying a hard asset. Like I'm buying a house and I'm going to fix it up and then I'm going to lease it out. That's not a passive thing. That's more of I'm starting a business essentially, and it's a real estate business and there's elbow grease required. But in those circumstances, if you can't turn something into cash readily, then you should expect above market returns, because you could buy the S&P, and if you hold it over a full economic cycle, 10, 15, 20 years, history has given us a sense, not that it's telling us about the future, but it's given us a sense of historically what can we expect for a passive investment. Right. Passive in the sense that I'm not like running a business. I'm just buying a fund and letting that fund do what it's going to do. And that'll maybe be 7 to 10%, depending on which 20-year period you pick. But I need to get a lot more than 7 to 10% per year if I'm going to tie up my capital in something illiquid. So you need to be thinking about liquidity, dear physician, and make sure that if you're giving up liquidity, you're getting something compelling in return.
Yeah, I agree. So if people want to, diversify their portfolio, right? So, and I can speak from, my own personal experience. And it's interesting, actually, I was doing research for this show before, we jumped on the microphone on the recording here. And there's a suggestion actually at Vanguard that you should own at least, I want to say it was 20 or 30% international exposure. I can't find my notes on it at the moment, but I'm pretty sure that's what it was. I think it's 20%. And so, for me, like, I don't, like, I'm like right at 15, I think. And so, how much diversification is needed, I think is a question that's worth considering. Personal finance being personal, I can't tell you what that number is. Well, let's say someone wants to increase their number above 0, right? Is broadly diversifying through a total international index fund, is that sufficient to people be, more actively, selecting emerging markets like you mentioned earlier? Like, where does someone start in this journey to figure out what's best for them?
Yeah. So I know doctors love to have the 99 percentile answer, because when you don't, sometimes people die. But the fact is, in investing, just moving a decile in the right direction is often way better than where you are now. So I would encourage you to not try to find the 99th percentile. Just figure out, how do you do better than what you're doing today? One interesting way you can get a window into I'm going to put this in air quotes for our audio only people, the smart people at Vanguard, at BlackRock, at these big money managers, how are they constructing portfolios? You can actually go to the target year fund, the retirement life cycle fund, whatever they're calling it, the Vanguard 2050. And this is designed for people who are going to retire in 2050. And what you can do is just rip out the equity piece of it. So you look at the pie chart for that fund and say, okay, for the equity piece, there's a ratio, maybe it's 70% stocks, 30% bonds. Just rip out the 70% stocks and say, what's in here? Now, for Vanguard, my recollection is that they are using just a global market cap weighting. So that 70% stocks is probably 60% US, 40% international. And then so it's even more pronounced, Jimmy, than the numbers you just threw out. And of that 40% international, there's a further sort of subdivision between international developed, like the Frances and the Switzerlands and the Japans, and the international emerging, which is the emerging economies that are very volatile, very risky, they could double, in the next year, or they could get cut in half in the next year. And so Vanguard says 40% is the answer, is sort of the bottom line of what I'm giving you. I work a lot with Dimensional Funds, which is another big money manager. Dimensional has, instead of a 60-40 US to international mix, it's a 70-30 US to international. So again, the smart people out there who are constructing these portfolios at the most sort of fundamental corporate level, when they're building these products for people to invest in, they're in that 60 to 70% US and 30 to 40% international. I also think that the dimensional funds, which is what I'm more familiar with, it's something like 2/3 international developed, 1/3 emerging markets. So if you're just looking for some broad category, even if you're, frankly, if emerging like makes you nervous or you're not sure what you think about it, just let's take some baby steps here. And this is a perfect place to engage an advisor and talk to somebody who has and frankly, there's a lot of advisors out there who, some of them, are smart. Some of them are well trained. Some of them understand portfolio and asset allocation, and many of them are asleep at the wheel. So I don't want to say they're all created equal, but this is a place where engaging a professional could be useful when we're talking about technical topics like portfolio construction and the change in composition affecting risk and expected return over time.
Yeah, and this is also where I'd encourage you to go back to that episode where you and I, Justin, talk about financial planner fees, because we talk about some criteria for finding a financial planner. So if you're interested in doing that, if you happen to be an anesthesiologist or a pain doc, obviously I'm talking to the best one right now, Justin. You work with those people. But otherwise, I think that this target date fund is actually an interesting thing that you just brought up. right? And like diving into those because historically on this show, I've been, let's just say like lukewarm on target date funds. And one of the reasons why, hilariously, is that it has too much international exposure for my liking, right? So like I don't tend to go to that 30, 40. I tend to be, around 20-ish. And so that said, I'm not going to claim I'm smarter than, Dimensional Funds or Vanguard or BlackRock. It's just been kind of like, my gestalt, my, putting my thumb in the air and saying, like, where do I think this thing's going? And so, that said, I don't want to make this not an anti-target date fund episode because we could go way down the rabbit hole on that. Maybe that's a time for a different topic, a different episode. But I do think that's a really good way to kind of get a sense for, like, if you're at 0, right, and these other places are at 30 and 40%, right, maybe that baby step is like I've taken like 15 or 20, right? And maybe someday you get more comfortable and you wade deeper into those waters. But it does seem like something more than zeros is reasonable. And actually, I was reading a BlackRock research article on this, and they were talking about that recent lag and kind of that need for diversification. And they kind of split it out a little more, like just a lot of people look at this very broadly and say, well, they've done worse over the last 14 years. And therefore, I'm not interested in investing them. But when they looked at this and they looked at international stock markets outperforming the U.S. stock market 100% of the time when U.S. returns were less than 4%, and that when U.S. returns were less than 6%, it was still like 90% of the time. And so, yeah, if the U.S. market's going gangbusters and it's 22%, like it's recently been, then yeah, I mean, international is probably going to lag. But apparently, this whole diversification thing that you and I have been talking about, when U.S. stuff does poorly, let's say, I don't know if 4% is poor, but not as good as 22, apparently international stocks tend to perform well. Right. And so I liked it that in their research, they split this out a little bit more. They kind of took a fine tooth comb to this conversation. And that was from 1971 to 2021 for those that are interested. But I found that, a pretty solid case in my mind for the diversification that we're talking about.
Mm-hmm. Yeah. And we could have another conversation about factor tilts, which perhaps we should in the future in terms of like value versus growth and other ways to sort of cut the indices. But in terms of international and emerging, this is particularly true in emerging markets. One of the things to be aware of is you don't want to wait until emerging has shown that it's now doing better to jump on the bandwagon, because it happens really fast. And by the time you recognize it and react, emerging is up 54%, and like, dang, you actually just missed it. So the time to diversify is the time when you're already winning. Like if you've been in the S&P 500 for the last 13 years, good for you. This is the perfect time. Well, I don't know if it's the perfect time, but with what we can tell right now, based on the relative outperformance over the last decade, this is a time where the numbers suggest that it's might be a healthy time to consider expanding into these historically underperforming markets. Because when that pendulum swings, you want to ride it, back up. You want to get into emerging, get into international developed at a time when, if they get that below the trend line data point upon data point upon data point, as long as the mean reversion does occur, you want to participate now, not after the pendulum already swings.
Yeah, no, I think that's great advice. Well, I love that this show, we touched on like a big, broad investing, principle of diversification, and more specifically on international funds. So hopefully you found this interesting topic of conversation. Justin, I love the insight you bring to this as a planner in the trenches and kind of your thought process on this. But as we tie up the show, everybody make sure to snag a free copy of the Physician Philosopher's Guide to Personal Finance. You can find that on moneymeetsmedicine.com. And make sure to share the show with your friends and family. Obviously we love impacting all of you, love the emails that get to have some insight into how the show is helping you. So if you want to hear certain topics, concepts, you've got questions you want Justin or I to answer on the show, send them my way at jimmy@moneymeetsmedicine.com, and we are happy to take a crack. Everybody, we will see you next week. Cheers. Justin Harvey is a certified financial planner at APM Wealth, where he helps anesthesiologists and pain medicine physicians. Dr. Jimmy Turner is a practicing academic anesthesiologist at Wake Forest in North Carolina. He's also a licensed insurance agent. However, either Justin or Jimmy are your financial planner, investment advisor, or insurance agent. This show is expressly for general education and entertainment purposes only. Nothing should be considered financial advice. All views expressed are solely the views of the guests on the show and do not represent the views or opinions of their employer.